Prashant Kumar. He's the founder and managing partner. He'll introduce himself and um, over to you, Prashant. All I can say is he's comes from an elite institute in India, IIT. Is that IIT Delhi, if I remember? And
IT
uh,
Roorkee, actually.
IIT Roorkee. So it's a top-notch engineering school in India. But anyways, I'll hand him over and describe his own journey in his own words. Please feel free to put your questions in the chat box, and we'll continue here. Thank you. Go ahead, Prashant.
Yeah, thank you, Braj, for this opportunity, and thank you, Lam, for leading this conversation into real estate. As Braj said, I come from one of the good institutes in India, IIT, and I've worked in a lot of life sciences companies. By profession, I'm not a doctor, folks, like you elite folks, but I've worked in life sciences. I have great association with life sciences. I work with Pfizer. I currently work with Cardinal Health. Do some consulting for them, and I have done, as I said, Pfizer, Bayer, pharmaceutical, and a lot more life sciences companies in my previous lives. Over a period of time, I realized that we all are busy and we all are trading our time for money. But the day we don't work, especially with not that much high paying jobs. I was making decent money, but at some point I realized that I have to transition into something which makes money while I'm sleeping, right? That's the real purpose. A lot of people are in real estate. In this group itself, I transitioned into, like everybody else, into single families, and I realized that it's not worth my time. Banks take a lot of time giving me a loan, a small loan, 300,000-400,000. It goes on against my income. So I realized that single family is not. I can buy maybe a couple of single families, 5, maybe 10 at most. After that, it would become a little difficult for me to expand or scale my portfolio. So I started looking into commercial asset classes. Multifamily is the asset class, which I chose for obvious reasons. Number one, it is commercial asset class. Scalability is pretty high. And it is almost always full. It's not like office space or the retail where we are dependent on few tenants only. We are dependent on diversified tenant class, different kind of tenants. Let's say if I buy a 200 unit apartment complex, my income is dependent on 200 individuals who are earning, right? Even if one person leaves, it doesn't affect me that much. In a retail scenario, you have 5 tenants and one tenant leaves, your income goes down. Your cash flow goes down by 1/5. So for that reason, we chose multifamily, and multifamily has many advantages. Overall, it's a stable asset class, and our yearly occupancy. Normal occupancy, average occupancy in United States is more than 90 to 95%. So it's really, only 5 to 7% people are leaving and coming in, leaving the apartment complex and coming back in, right? So if I calculate my projections, if I calculate them at 90%, I have already accounted all the scenarios where people would leave or people will come back in, right? And if I can make money at 90% occupancy, then probably it is a good deal. So, to cut short, basically I moved from technology to an asset class where I can scale my lifestyle or scale my portfolio at a very high speed. I didn't do too much. I own about 15 $15 million worth of portfolio. When I say own, I syndicate them. It's not my personal money. I do invest, at least 5% in any project, so that I have the accountability, so to say. But the goal for these projects is really, yes, as a management, we make money, but our goal is to continue to provide opportunities to our friends, family members, or other investors, who have money sitting in their bank account and depreciating because of inflation. And right now is the best time, when inflation is so high, reaching up to 6%, 6.2%. We are devaluating our money by 6% every year. If I have $100,000 sitting in my bank today, after a year, on December 15th, 2023, it would lose its value by 6% or so. So we have to find places where we can get at least that much return to keep the value of money similar, right? And there are many things, stocks, bonds, there are many asset classes, many things to invest into. I feel like real estate being a tangible asset. If I buy $1 million building, it's going to be there forever, right? It's not that it's going to disappear in a thin air. So that gives the highest degree of confidence to buy something which is tangible. And over a period of time, we have seen that real estate has gone up always. I mean, maybe there could be a drop sometime, but it always comes back. So that's the reason why we chose, when I say we chose, our company chose multifamily. And besides multifamily, we always look for other asset classes also. We invest into assisted living. That is also fairly stable asset class. And then, as Dr. Lam said, storage, mobile home parks. We have not invested into storage and mobile home parks yet, but that could be on the horizon. It's not that we are not, just too many things to do. I mean, so right now we are focused on multifamily and assisted living. I mean, over the next couple of months, actually over the next 3 months, and it was supposed to be this quarter, but I had some family hiccups, so things got delayed. So first quarter of 2022, we will be closing about $50 million worth of projects that we have been working for last couple of months. So that is sort of my background. I'm here to answer any questions that you may have, but if Brad says, I can probably share some details on at least one of the deals with everybody, if that's okay with you, Braj.
Yes, I had, I think Dr. Sue asked one question. Dr. Sue, you want to ask your question? Unmute yourself.
Oh, I'm sorry. I was doing other things. Okay. Yeah. Just to give you a background, I did real estate for 30 years and recently retired, and I still find it fun. The problem now is that since I'm retired, I can't qualify for anything, even though I have passive income flows of 50K. Where's the best place to get a loan now?
Yeah. So that is the reason, right? That is the sole reason when I said that I moved into commercial real estate. Just for an example, if my W2 income is 100,000 or 200,000 or whatever, if I'm buying single family homes go by debt to income ratio. Those are non-commercial assets. The bank look for your income and weigh that whether you are able to pay the mortgage that you are buying a house for, right? So it's called debt to income ratio. If you have too much debt, if you end up buying a couple of homes and your income is still the same, there comes a time your debt to income ratio becomes, income to debt ratio becomes too less and bank doesn't lend you. And same thing in your scenario, that you have no active income. You have passive income, but bank doesn't consider that too much, basically. So this is the residential scenario. 1 to 4 family homes are called residential loans, and bank always look at what individual makes, not what property makes. Now, if we are in commercial asset class, either retail or office or multifamily, anything above 5 units, 5 plus, 5 plus, it could be 5, 10, 20, 100, 200, 500. Bank looks at the income produced by the asset and what is the debt service. So if the property makes 500,000 in a year and the bank loan is, debt service is let's say 250, you have DSCR, debt service coverage ratio of 2. As long as the debt service coverage ratio is above 1.25 or 1.3 or 1.4, bank gives you the loan. It does not matter how borrower as individual is making. A borrower may be a retired person. A borrower may not be making that much. As long as it has a sound standing, right? Nobody is bankrupt and, all those things are not there. As long as you can prove that my net worth is so and so, and this is the loan I want to take, this property is going to make 500,000, but my debt service is only 250,000 a year. So my debt service coverage ratio is more than 1.3, 1.5, whatever. You will get the loan irrespective of your income, whether you are retired or not, it doesn't matter.
We have a question also from Robert Marlin. You want to introduce yourself, Robert, and then ask your question, please?
Yes. Good afternoon. My name is Robert Marlin. I'm a former ear, nose, and throat, head and neck physician. I currently work in federal healthcare. And my question is, I do residential real estate, both condominiums as well as single family homes, in a segregated LLC structure for liability protection. And my concern, though, doing what I do is I have an active income without a lot of work, but what hurts from the investment side, and I haven't found a way around it, is the tax basis, meaning my accountant tells me correctly that I have to report this as earned income rather than investment income. And so even though my return rates are decent, when you pay personal earned income taxes, it really deflates your income from the properties. And I was wondering how you handle the tax basis and whether you're doing that as a pass-through corporation or a pass-through corporation to yourself. And so how do you pay taxes on the income you generate? Over.
Yeah, so I am not an accountant or a CPA or a tax advisor by any means. So my opinion really doesn't count that much. The second thing is, I must say that I do not invest in single families. So I am, I would not misguide you. Probably you know more than me anyway. Commercial and residential are two separate asset classes. And, in commercial, we just do things very differently. We do the cost segregation, which is depreciation, and through which we are able to offset our capital account balances considerably, giving a lot of depreciation to our investors and to ourselves. So that any active or passive income that is generated gets wiped off by losses, the passive losses that we create. But in short, I'm not qualified to answer correctly your question. I apologize
Dr.
for that.
You have any comment?
Lam, would you have any suggestions on that?
Yes. Actually, in terms of single family, if you are fixing and flipping, you're considered a dealer. So it's true that your income would be considered an active income. So that's treated differently from the multifamily space, because most of the income coming from the multifamily properties are considered passive income. So that's why you get the different tax treatment.
Yeah. So single family is active income because you are there. You are doing even though there's a property manager, you are always working. Multifamily, if we invest in somebody else's syndication, we are limited partners. We don't have management authority, and any losses generated are considered passive losses or passive income.
I have a question.
Yes.
If I have $50,000 that I would like to invest, why is not a stock market better than the real estate? They're both subjected to market forces.
Yes, a very good question. Very good question. So basically, the stock market is typically considered as your capital gains. There's no depreciation there, right? I mean, you are working, you have your own risk. Okay, let me ask you this. How many times have we looked at the financials of the companies before investing anything in those stocks? Do we really know? I mean, to me personally, and it's my opinion, guys, pardon me if I'm offending somebody. To me, it feels like gambling, that I'm gambling based on market forces, but I really don't know the fundamentals of the company. Companies do have they do publish their reports, but am I really qualified to understand their financials? But in multifamily, we do so much research. I mean, I personally do so much research, 3 months worth of research before I invest in a project as a syndicator. That's number one. Number two, there are bigger players than us who are monitoring those projects. A bank who's lending, they want to make sure that this project is successful. No, none of the banks want us to go in default, right? I mean, things do happen, but none of the banks want you to go in default. They underwrite the deal very carefully. Then you have professional property manager who's handling the property, and you are managing them. Then you have SEC filings, making sure there is no goof up. This is not a Ponzi scheme. So there's a lot more control, and you have the control because you can pick up the phone and call your sponsor, say, Mr. XYZ, I invested. What is going on? Can I have that conversation with a $1 billion company? I don't think so. So my point is, besides the advantages of depreciation, cost segregation, etc., my point is, I feel it is in our wheelhouse, and we are able to control our money and our destiny. And it's not that we are just playing golf. I mean, we are spending a lot of time, a lot of energy trying to vet the opportunities, trying to vet the markets, trying to vet tenants for that matter. I mean, we look at the tenants. Sorry.
Prashant, you will scare people. They would never do multifamily.
What is that? No, I mean, so that is the work that a sponsor does, right?
Yeah, the people don't realize that, how much work we put in these, deals before it comes out. Means 3 months. Prashant, one thing I'll tell you about Prashant is I've known him for a couple of years, and he's a very humble person. So he was always going to underplay. He puts in a lot of work in these deals, and the deal he's going to talk about, he has been working it more than 6 months actively. And before that, he has probably worked it more than 6 months to get into that deal. And there's a story behind it. I'll let him share that. So there's a lot of
maybe
work.
This is the right transition to why don't you share what you have for our members, Prashant. And
Okay.
Daniel, Ruben, while Prashant is sharing, you can ask your question quickly.
Okay, I'm gonna share my screen, and I will talk very briefly. I'm not gonna go into the details too much. And Dr. Chanda, thank you so much for standing by me. And we have talked about this deal, so you have the background.
Yeah.
But I'm going to share my screen, and I'm going to talk a little bit about this project. So basically a project that we are currently working on, and this is one of the projects basically. It's a Viva Max apartment homes in San Antonio market, right? It's a 200. Before I go into that, I just want to make sure that we understand that this is a confidential information, can only be shared with those who are somehow we are connected with, and I understand that everybody on the call is connected with Braj in some fashion or the other, or his organization. So this is not publicly shared information, and what I'm talking is only for the entertainment purposes. These are not tax advices or anything. So that's a disclaimer I have to say by SEC rules. Just a little bit about myself. I have already talked about it. I'm a certified commercial investment member. I worked in life sciences industry. I own, I have participated in 2,000 units in my lifetime. I live in Long Island. I have management background. I have managed projects across the world, traveled widely within the United States, weeks after weeks. And I have dealt with different personalities all the time in different companies. I named a few of them before. But just very quickly, why San Antonio market? Why we chose San Antonio market is because the market has strong fundamentals, right? It's a very strong market, where population growth has been there. There are a lot of companies which are headquartered. It's one of the fifth, one of the best big cities, and great population, and a lot of labor force. More than 80% of population is labor force in San Antonio, which makes ideal candidates for renters basically. So Microsoft has been there. You name it. You have Chase, Hulu, New Star, City, Amazon. A lot of companies there, and I'm not going to bore you with all the statistics and everything. Just to give you some background where the property is located. There are a lot of companies around South Medical Center, about a couple of miles away from this property, and a lot of employment opportunities around the area, right? Serious Computers, New Star, SWBC, Task Us, you name it, is basically. So, just a little bit about the property that we are buying, 240 unit apartment complex that we are buying, 1983 built, 176,000 square feet. It is occupied 97, as of June 21, it was occupied 97.9%. As of November 30th, it is 100% occupied. So just few pictures about the property, very good looking asset, B-class asset. We consider B-class as a good asset. It's not a luxury apartment complex, but decent apartment complex. It has good picnic area, private clubhouse, things like that. Pet friendly community. So what we want to do when we buy this asset, what we want to do in this is we want to improve the amenities. The basic idea is once you have bought an asset, you improve the rents. By improving the rents, we increase the valuation of the asset. The asset is currently cash flowing. It is 98% plus occupied, so it is already making money. But when we go in, we put in more money, we inject more capital in this asset, and we improve the asset. By improving the asset, we increase the rent roll. And by increasing the rent roll, we improve the valuation of the asset. That is actually the business plan in a value add opportunity syndication scenario. So what we plan to do here is, we want to improve the amenities on the property, dog park, fitness center, barbecue, put a fresh coat of paint, rebrand the property, address any deferred maintenance, improve the, put a, really good property management company there, and improve things in the, there are about 74 units which haven't been upgraded for some time. So we go and do the upgrade of those units. So in total, I mean, our rents are about $125 to $200 below market. So our goal is to capture that rent growth for that, right? So for those 75 units, maybe capture $125 to $150, but they are a standard units. We can easily get $100, $50 to $100 rent growth. These numbers may look small to you, but if it's $100 per unit multiplied by 240 means 24,000 per month, multiplied by 12 months, that becomes about $300,000, right? And if the market capitalization is 5%, that $300,000 means that you have increased the valuation of the asset by $6 million. By increasing the rent by $100, you have increased the valuation of the asset by $6 million in a year. I just wanted to give you the perspective that $50 to $100 is a lot of money, not from a cash flow standpoint, but from a property valuation standpoint. And plus, the current seller is marketing all by himself. He is not that tech savvy. So we will try to market it in a proper way. So that is our business plan. Okay. So this is our capital stack, how it looks like. It's a $28 million project in total. We are buying it at $25 million, and we are getting some equity from a bigger investor, $7.5 million, and then we are raising about $5.6 million ourselves, with our friends, family members, and the folks whom we know. So in total, the sources and users is about 28 million here, right? But the amount that we are raising from our investors, from ourselves and from our friends and family members is this basically 3.9 and 1.7. So this is what we are raising. We have one investor who brings in 7.5, and the bank gives us 15 million on this property.
Prashant, you have a 1 minute time check. So if you can, so that we'll have time for question and answer. Go ahead.
Yeah. I'm gonna we are just about done actually. So I want to go to, I want to basically show for what I just showed a minute ago, that 5.6 million that we are raising from our, friends and family members and investors. We have two types of investments here. One is, I'm a conservative guy. I would probably put in fixed. I want only 10% fixed return. So that is a possibility. Somebody wants to come in, they can have 10% fixed return year over year, right? But they don't get any upside in the end, but they do get 10% return. The second is somebody wants a little lesser return now, but over a period of time, when we exit from the deal, at that time, there is an opportunity to share 80% of upside in the deal, right? So that is distributed back to the investors. So one is 10% fixed or a 7% with upside. All of them have, tax advantages. Basically, the 7% has IRR. Those who know it, for whatever sake, it is more than 14%. And I'll just show you three scenarios. We have projected a very conservative growth rate for San Antonio market, which is 4%. Most likely is going to be 5%. If you see the numbers, the 10% is fixed, but the ones who get into 7% scenario, they end up making about 90% return on their money if we keep the property for 5 years. So this is our most likely scenario that we are proposing, that this is what will happen. But I mean, I know personally in my mind that we may end up getting more than 4% growth. So this is 3% growth, 4% growth, 5% growth. Even if we are in the middle, we are going to make about anywhere from 17 to 20%, 17 to 25%, somewhere in between. That's my personal assessment. But I mean, that doesn't mean anything. We are writing that most likely we will have this scenario 4%. 4% annual growth gives us about 17, 18% annualized return. So the cost segregation that we were talking earlier, those who invest, if I'm investing 100K, so basically we are going to get about so we are investing 5.6 million, right? Out of the 4.6, about 4.6 million will be depreciated in year one. So more than 90% of, more than 85% of the money will be depreciated in year one, the investor. So if I have invested 100K, probably I'll get 85,000 paper loss for my project. So that gives a lot of boost to real estate investors, and especially those who are real estate professionals. They can offset it against their active income also. But even otherwise, whatever depreciation we get, that sits on our tax statements. We can take it 25,000 every year, so it goes on basically. So that's the basic advantage for projects like this. Yeah, that's all I have. I mean, I didn't go too much into details, but I hope I have given some information about this project.
Thanks, Prashant. I know we are running over time, so thank you folks who has to drop off for joining this meeting. We'll have more of these. Seems like we got a lot of, though I published it 2 days ago, we had more than 80 registrations and a lot of good discussion. So I'll take some questions. So whoever can hang around for a question. Nive, you want to ask your question? And introduce yourself.
Yeah, I'm just wondering, right now.
Can you introduce yourself too, Nive?
Hi, sorry, I'm Nive. I'm a physician, and I just invested in another syndication, but that is they are making it from ground up, like it's a new construction. So looking to diversify. I guess my question is that currently the property is like 100% occupied with and it's like cash flowing with a certain like with the renters maybe who don't want any frills, and we are upscaling, like if this project is like upscaling the apartment, and then whoever is buying it is going to expect like that they're going to have still a cash flow and a higher rent, but then like renting for like 1,200 versus renting for 2,000 is like the renters decrease a lot. So how do you ensure that, that, I mean, I agree that if you improve the property, that the property will appreciate for more. But then how do you again get the buyers who would look at it, I will still have some cash flowing but then you'll have less renters at that point.
No, I mean, see, basically it is not about you are going to you are not changing the asset class from B class to an A class, right? That's not what we are doing. We are not changing the rents drastically from 1,200 to 1,800. We have already done the market survey that if we end up increasing, if we modify the property, and if we end up increasing the rents by $75 to $100, let's say, there is already a demand. I mean, our rents are below market anyway. We are about $50 below market anyway, but with added amenities, we would be able to enjoy at least $100 more. And there are comparable properties which are achieving that rent already. So it is not that you are going to lose the renters. I mean, all that analysis is done not just by us. I mean, it's basically based on all the reports. We walk through a lot of properties to make sure that those properties who are charging more than us, they are also occupied completely and they're in the nearby area. So I would excuse myself saying that that renters would not go down. I mean, there would be slight fluctuation in the occupancy because we do have to fix some of the units, right? We will fix 5 to 10 units a month, but as we bring them back, they will get filled up. I have no, because right now it's 100% full. It means there is a demand there already.
Yeah, I guess I'm trying to find out, like, the 25 million that you're investing in the property, like the hope is that somebody else is going to buy it with the appreciated value, as opposed to
there is always a buyer.
The property will appreciate anyways, in the sense that it's a rental, like it's a real estate.
There is always a buyer. Okay, whenever we are buying in a real estate. Yeah, sorry, go ahead.
Can I chime in a little bit?
Please.
So, Nive, the way it is, what kind of a physician are you?
Oh, I'm a pediatric intensivist, like a
Okay,
PICU.
Perfect. So what happens is that I'm an anesthesiologist, cardiac anesthesiologist. So the way it is like we are so used to thinking in absolutes, that there is a disease or there is a no disease, that the absolutes, what it is here is that the demand is not about, getting it appreciated and selling it. And the question is not that who will buy it, but there is a constant pressure in the market because there's not much product available at that pricing. And the pricing is basically dictated by how much money you are generating out of the property. So what it is in this property, the market rents are really low. And anytime we see a property 100% occupied, we salivate over it because we realize that the operational element of that property is very poor and the rents are not being aggressively forced in that particular apartment building. That's why Prashant went after it, because he already knows the rents are below market right now. So what he's showing is that whatever appreciation he's doing is by improving the efficiency. And on top of that, he's layering that with an icing of renovations and making that environment better for the new tenants. So that's what it is, and it's not about artificially pitching in kind of elevating the value to some, like, it's not about hope. It's about really executing that business plan and making it happen.
Thanks, Dr. Mishra. Dr. Ruben, you have a question?
Yeah, what is the purchase cap rate?
So the purchase cap rate currently is just below 5.
Purchase cap rate? I'm pretty sure a lot of our
the cap rate is typically the way we calculate the cap rate is net operating income divided by purchase price. So purchase net operating income of the year, basically, which is
like the unlevered yield.
Yeah, unlevered. Yes, it is. No, leverage doesn't leverage doesn't come into calculation of the cap rate.
So the lower the cap rate, the higher the price.
Higher the price. Yeah, lower the cap rate, higher the price. Yes. So we are getting in just below 5 cap rate right now.
Just below 5. So the idea of selling it in 5 years, if you assume a similar cap rate that you're going to sell it at, then there's going to still be an increase in value because you're going to be increasing the NOI, the net operating income.
100%, yes.
So that alone can increase the value.
That alone can increase the valuation of the asset. Yes, 100%.
Especially if it's leveraged.
Yes,
that'll increase it nicely. And San Antonio is a wonderful market. That's I personally, my opinion too is it's a wonderful choice.
Very good, very good. And in our underwriting, we typically don't exit at the cap rate that we get in. We assume that the market will go down, so we always put in some buffer, 40 to 50 basis point in our underwriting. We assume that market forces may change, so we say that our higher exit cap rate is a little bit higher than the purchase. Entry cap rate. So
that's good to be conservative.
To be conservative, yes.
Absolutely.
Thank you, Dr. Ruben. Thanks, Prashant. Maybe we'll close in very quick few minutes. If anyone has question, please feel free to unmute yourself and ask a question. Thanks, Dr. Ruben, saying this is a great gathering. This is our first time we are doing something related to real estate or any kind of education to our Innovator MD group. So this is exciting.
So Prashant,
go ahead.
Have you shared how people can get in touch with you and talk more about you?
We will send that in follow-up email, but if you want to share some screen, that's fine, Prashant.
So Braj, maybe you want to share your link or maybe the webinar that we have put together. If you want to share that along with the link that I have given you, if somebody is interested, at least put that in the chat. That way, anybody can copy that link.
I would just request one thing is, even if you are not interested, just watch the webinar. It's like learning so much about and what you'll be surprised is how much work goes into putting these deals together, and how much data is collected, and how much people kind of work hard behind the scenes to bring it in front of you.
Yeah,
thanks. It's kind of like remarkable.
I got few questions on the messages somehow, Prashant. If I can ask you,
please.
So in this one, who's the loan guarantor?
So I mean, I'm the loan guarantor in this project.
Is there a third party, or you are directly the loan guarantor?
No, I'm the loan guarantor actually. Prashant Kumar personally is signing off the loan.
So in the meeting, we see you, and it's great with all your description. But so you seems like key person risk. So what's the key person risk plan? Who is in command if something happens to PK? He gets hit by a bus.
So basically, these projects are owned by. There are multiple managers on the project. I have other manager also on this. I am the key. My Realty Gains is the key sponsor, right? But there are other general partners in the team also. So if Prashant Kumar gets hit by a bus, and there would be somebody else who would take over the project. Project is actually speaking. Once we close this deal, project is managed by a professional property manager, right? And we manage the asset, right? So there are multiple general partners in the team, so the project remains independent of anyone's individual's availability. But we do manage the project. I personally manage all the projects that we own, but there are always multiple people. It's not one person shop. There are about 5 to 7 people typically managing one project at a time.
Mm-hmm. So there is a question in the chat box. Can we invest a combination from solo 401k and non-retirement funds?
That is correct. You can write. So basically, these are two separate entities. I can invest as Prashant Kumar. I mean, I personally cannot invest from my solo 401k, but yes, any investor can. Investor X can invest from Investor X non-retirement fund, and they can invest from their solo 401k also. Yes. So there would be two separate PPMs that they will have to sign, one in their personal name and one in their solo 401k's name.
Okay, thanks for the idea, Dr. Mishra. I did put in a link to as an Innovator MD co-sponsoring this, where people can have details about this the conference. One last question, Dr. Prashant, and if it was somebody else's project, what are the 3 things you will put as a devil's advocate not to invest in this project?
Yeah, so I definitely look at. I mean, I also invest in others' projects also because I need that tax depreciation. I always look at where the location is, right? What is the growth potential of the market, right? I'm not going to go and invest in the middle of nowhere where there's no job growth. So job growth, income growth, and future potentials. These are the important things that I would look for. And who is the sponsor, right? I mean, if the guy is new guy doing it for the first time, I would probably remain away from them. And in addition to that, basically, what is the track record? I mean, the same thing basically. So income, so growth potential, and and their track record. These are the most important things that I would look for. And one more thing I would look for is that they are not cutting themselves short trying to raise the equity, because those who are seasoned syndicators, they know that whatever they project, there is always unknowns. So those guys are not just cutting themselves short. So that's all I
Sorry, actually, the question was just the opposite, Prashant. The question somebody asked was, why would you not put your money into this? If you,
so
what will be your concern? 3 concern, like, oh, could there be flooding happen in San Antonio, or could there be a collapse of? So just tell your concern. So my
opposite
of what you said.
my concern would be, if it is not a growth oriented market, I would not go there, right? If the sponsor is new, I would not go there. If there is no track record, if the sponsor is trying to cut themselves short, I probably would not go there. Flooding, of course, I don't want to go in the tornado prone areas. So there are many, I mean, United States is big enough. I can find better places to invest. So I always look at the track record and the growth of the market. Basically, these are the important things.
I'll take just one last question from Nive. Nive, you want to ask your question?
Sure. Let me see if I can unmute myself.
Yeah, you are unmute. Yeah.
So, like I have single family properties, and so I claim real estate through that. And, all the repair work that's going on, there's like a lot of labor shortage and a lot of supply. Like, you order something, it comes after 2.5 months instead of coming after 1 month. So I'm just wondering if that would affect the bottom line for this proposal, because a lot of it is hinged upon the fact that we are going to there's going to be like a lot of renovations and all this work involved.
So when the renovation happens, it's not that we are going to remove the tenants, right? That's like you are killing yourself. So we renovate only when leases are up. So this is a 240 unit apartment complex, and on an average there are 20 leases which are up every month, right? So renovation, I mean, we plan to take only 10 units per month, 5 to 10 units which we will renovate. So our goal, I mean, we don't make our units non-revenue generating just for the heck of upgrading it. Our goal is to half the units we are renewing as is, and half the units we go quickly, upgrade them and put them on the market right away. So San Antonio being San Antonio, the turnaround is very fast, right? I mean, labor forces are there who can turn a unit within 7 to 8 days. So 5 to 10 units, they work, 5 different teams work together. And we do consider a dip in occupancy because of that. We do, instead of 95% occupied at that time, instead of 97% occupied, we consider 93, 94% occupied during that time. But the impact on our numbers, I mean, we already consider that. We already consider that in our numbers.
We have one last question from Dr. Purohit. Do you want to ask your question, or should I read your question, Dr. Purohit?
So Braj, I must say one more thing. If you have the link to the presentation and the password, if you can put that also,
okay.
That way everybody can copy directly from the chat from here.
Okay.
I mean, they can always get the email, but they can definitely get it from the chat itself, if that's possible for you. Sorry, go ahead. Go ahead for the next question.
Dr. Purohit, you introduce yourself. I know you, but
yes, no worries. Hi, I'm Trita Purohit. I'm a gastroenterologist in the Bay Area. I apologize. I joined a little late, so I don't know if this has already been asked. One was just wanted to know a little bit about your track record. How long have you done this? How many deals have you done? And the second was this deal. What's the equity multiple like? I'm sure. I don't know if it was asked already.
Yeah. So basically, my track record wise, I have been in the market for about 5 years now. I have invested as a general partner in about 2,000 units. This is my 9th deal. We have exited 4 deals already. Our returns have been so far, I mean, not to lure anybody, so far has been beyond what we have promised in our deals. And in the current deal, our returns are 1.5 times for A1 investors. I share two classes. One is 10% fixed. So for 5 years, it would be 1.5 times. But for those who invest into A2 class, there the returns are 1.85 times in 5 years. So equity multiple is either 1.5 or 1.85, depending upon which share class one chooses. One more thing I must add is, because the deal has been out there for whatever duration, so our share classes are almost full, getting towards full. So at this point, we are accepting money half and half into two share classes to kind of maintain the balance between two classes, A1 and A2. So if somebody wants to invest 100,000 or 200,000, if 100,000, maybe 50,000 in A1 and 50,000 in A2, something like that, to kind of maintain the balance.
Got it. Perfect. Thank you so much.
Very welcome.
Thank you, Prashant, and thank you, everyone. I know we are over time by 20 minutes. Oh my God. So thank you, everyone. I really enjoyed all the discussion. I myself learning a lot through this process. I'm very new to this, and when I heard about this from my cousin and a lot of techie friends who were excited about this syndication, though they are mostly doing single family, I thought it might be good to learn for our physician friends what's the difference: single family, multiple family, do storage, self-storage, or do assisted living. Somebody had a question about assisted living. Maybe
somebody asked me about assisted, and I'll take only 30 seconds. So assisted living is also an asset class where basically it's a business, right? You are actually managing the whole thing. You have the operations also in there, but your rents per unit is a little bit higher, right? In multifamily, you have the property manager, you never see your tenant again, right? But in assisted living, you are working with your senior guests day in and day out. So it needs a special skill set. So our organization has personally partnered with assisted living managers who would manage those properties for us. But from a number standpoint, it is the similar concept, as I said, about multifamily. It is almost a similar concept, but it's a little bit more intensive work for an operator. So typically, those operators become our partners because they have some stake in the company and they do a good job that way. And lenders prefer it that way. So, I can talk more maybe next time, but it is similar asset class in terms of the investment proposition.